Ladies and gentlemen, welcome back to the channel. We have some big news, company-specific news to go over with AMC Stock, and hopefully there's a rhyme or a reason to what they are doing because this is a little concerning on a fundamental basis. Now, don't be alarmed or surprised. I'm sure nothing surprises you guys at this point, but really, none of this matters until the court proceeding, and then which I expect the MOAS to follow suit. But these developments in the short term can have an impact to AMC stock, not to mention a looming $500 billion crisis that is coming with massive bankruptcies hitting at the highest rate that you have seen since the global financial crisis and just likely to get worse from here. This could be good news for the short sellers and hedge funds, institutional investors, big money players that are short to their fucking gizzards in AMC. So let's talk about all of it here in this video. So AMC stock is down 2.63%. What is the news today? I'm not going to leave you guys hanging on the cliffhanger. AMC Theaters is scrapping its plan to charge moviegoers more money for better views of the screen. The company announced it is no longer moving forward with Sightline at AMC, a ticket pricing initiative based on seat location within the auditorium. This doesn't really make sense to me. This should be happening, but hopefully there's a reason for it. Hopefully it makes sense for them to not be doing this. But who knows as of right now? I'm sure we'll give the AMC the benefit of the doubt. I mean, this slight increase, like $1 or $2 more per ticket, probably not making or breaking people from going to the theaters or not. So maybe there's a good reason for this. Ultimately, we'll see. So that's a big story today, but as well as this one, quote, going to see a lot of defaults. $500 billion corporate debt storm is building over the global economy. A partner at Cleary Gottlieb, a law firm for corporate bankruptcies, he's advised businesses worldwide for decades on what to do when they're drowning in debt. He did so during the global financial crisis, the oil bust in 2016, and COVID-19, and he's doing it again now in a year when big corporate bankruptcies are piling up at the second fastest pace since 2008, eclipsed only by the early days of the pandemic. It feels different than prior cycles, Cooper said. You're going to see a lot of defaults. His perch has given him a preview of more than $500 billion storm of corporate debt distress that's already starting to make landfall across the globe. According to data compiled by Bloomberg, the tally is all but certain to grow, and that's deepening worries on Wall Street by threatening to slow economic growth and strain credit markets just emerging from the deepest losses in decades. And what they're basically saying here is bonds. Last year was the worst year for the bond market, but really for that 60-40 portfolio. You lost in stocks, you lost in bonds. Typically, what you would have expected to see last year is if stocks did bad, bonds did well. Everything did bad last year. There was nowhere to hide, and a lot of things have still not even come close to recovering. So this is putting a lot of strain on the system, even more obviously than what we've seen last year. Now, on the surface, much of it looks like the usual churn of capitalism, of companies undetermined by forces like technological change or the rise of remote work that has emptied office buildings in Hong Kong, London, and San Francisco. Yet underneath, there's often a deeper and more troubling through line. Debt loads that swelled during an era of unusually cheap money. Now that's becoming a heavier burden as central banks ratchet up interest rates and appear set to hold them there for longer than nearly everyone on Wall Street expected. The rising tide of distress is, of course, to a certain degree by design. Caught by surprise as inflation surged, monetary policymakers have been aggressively draining cash from the world's financial system, intentionally seeking to slow their economies by staunching the flow of credit to businesses. Inevitably, that means some will fail. But pockets of corporate credit look particularly vulnerable after ballooning during the years of rock-bottom interest rates, when even faltering companies could easily borrow to delay the reckoning. In the United States, the amount of high-yield bonds and leverage loans which are owed by riskier, less credit-worthy businesses more than doubled from 2008 to $3 trillion in 2021. Before the United States Federal Reserve started its steepest rate hikes in a generation, according to S&P Global data. Over the same period, the debts of non-financial Chinese companies surged relative to the size of the nation's economy. And in Europe, junk bond sales jumped over 40% in 2021 alone. A lot of those securities will need to be repaid in the next few years, contributing to a US $785 billion wall of debt that's coming due. That is a massive problem. And it says the pile of troubled bonds and loans has already surged over 360% since 2021, the data shows. If it continues to spread, that could lead to the first broad-based cycle of defaults since the great financial crisis. It's like an elastic band. Carla Matthews, who leads contentious insolvency and asset recovery at consulting firm Prince Waterhouse Coopers in the United Kingdom. Quote, "You can get away with a certain amount of tension, but there will be a point where it snaps." That's already starting to happen. With more than 120 big bankruptcies in the US alone already this year. Even so, less than 15% of the nearly $600 billion of debt trading at distressed levels globally have actually defaulted, the data shows. That means companies that owe more than $500 billion may be unable to repay it or at least struggle to do so. Oof. This week, Moody's Investor Service said the default rate for speculative grade companies worldwide is expected to hit 5.1% next year, up from 3.8% in the last 12 months ended in June. Under the most pessimistic scenario, it could jump as high as 13.7%, exceeding the level reached during the 2008-2009 credit crash. They're saying this is going to get worse than 2008-2009, or potentially could. Don't even think it's going to get that bad. If it got even half that bad, we're in big problems in the markets. And AMC is obviously in this boat, right? They have a lot of debt, and that's a bad situation. But in particular to AMC, your hedge funds, institutions that love the bond market, love these high-grade yields. You've seen on CNBC, especially in the first half of 2023, everyone wanted to own these 8 to 10% yielding bonds. These junk bonds, essentially, is what they're called. Well, that's looking like it's going to hurt quite a bit, to say the least. So that could help drain liquidity from our markets. Now, what you're actually seeing today as well, also helping to drain liquidity from the markets. If we look at Microsoft, down 2.5%. If you look at Apple, down 1%. Look at the S&P 500, down 0.62%. Look at the NASDAQ, down 2.10% today. Yeah, that's pretty rough. Okay, so your big money is getting drained today. And now you have the NASDAQ rebalancing that is coming next week. It could get worse from here. It could get much worse from here. So if we get an announcement from the courts, in which I expect will be imminent, well, that could come at a really bad time for the hedge funds and institutions. Now, keep in mind, these short positions are paying sky-high cost of borrow fees. Cost of borrow fees over 1,000%. But what they have to do as well when they short a stock, it's different than buying a stock, where you can only lose what you put in. Shorting a stock, you have infinite loss potential. So what happens is hedge funds, institutions, they have to put up collateral for these positions as well. You could start to get a collateral crisis that starts to play out if AMC stock does start to rally as the rest of the markets are falling. And that would not surprise me if it ultimately does happen. Now, live short interest of free float, 28%, 144.53 million shares currently sold short. The real short interest of free float is likely over 100%. It's likely around 125%. Just based on retail investors still likely owning around 80% of AMC. If that's the case, then your short interest is around 125%. If retail only owns 50%, while the short interest is likely around 75%. So these numbers, take them with a grain of salt, but this is the highest official reading for the short interest that you have seen throughout the history of the AMC short squeeze, right? You've never seen this before. Now, if you take a look at some of the option activity as well, it is highly suggestive of something big that is to come, expiring tomorrow. You've seen a $10 put worth $17.25 million. That's a huge trade. Now, you've seen a lot of other puts today. Overall, 18 orders totaling $19.71 million with a positive order value of 0%. Like, nobody is bullish on AMC right now. Look at the put to call ratio. Way the hell up here. Just nobody's bullish. That's the bottom line. Now, on top of that, earnings have been a complete disappointment. Tesla, Netflix, Discover, TSMC, all of these guys falling huge. Even Discover down 16% today. That's not good. That's not good at all. I mean, the lamest way to put it is just not good. And it definitely doesn't look good for next week and earnings as well. Likely a reason why the markets are falling so much today. Capital One, Intuitive Surgical, and the rest of the bank earnings today and after hours will also be very big to keep your eyes on. And then American Express Friday pre-market will also be very important. Now, specifically to AMC stock, AMC is down 2.63%. Again, none of this matters. Literally none of it matters. The credit crisis, the credit collateral, crisis, that is obviously important in terms of when AMC does actually start to rally. The rally doesn't happen, in my opinion, until the courts make their decision. Could be tomorrow, could be 2 minutes from now, could be next month. You really just don't know. But sometime between now and likely even next week, I imagine you do start to get an announcement from the courts, and that is going to start the short squeeze, at least in my personal opinion. These hedge funds institutions have not factored in paying 1,000% cost borrow fees for months. That was never part of the plan, right? So lots of different factors here that are bullish for AMC that are in play. We obviously have to wait and see what happens. I don't have a crystal ball. I don't know when some of these announcements are going to come from the courts. But as of right now, the best thing we can do is look at the data, look at the positioning, think logically what's going to happen next with AMC. If you think a short squeeze is coming, if you think this is ultimately a bullish catalyst, AMC raising billions and billions of dollars, at the same time, their loss has narrowed dramatically since the last time they raised capital. Well, it's probably a good time to be long in AMC. Maybe some of those options, longer dated, look kind of attractive right now. If you guys want to come trade with me live in real time every time I make a trade on AMC or any other stock, option, or crypto, link down below in the description of this video. As well as that, check out the links to get yourself free stock with Public, Webull, and Moomoo. Free money is free money. You can't go too wrong with that. So that is it. You guys enjoy the rest of your day, and I will see you in the next one.